In Chapter 2, we're going to be talking about securities, markets, and transactions. So we're going to be looking over the basics and the basis for which the American and foreign stock exchanges are set up. So how do we buy and sell or exchange financial securities? From a real basic perspective, what are the goals over the coming lectures? Well, first we want to be able to identify the basic steps in a securities market exchange. So what are the characteristics around the stock market? This may be brand new for you. For some of you, this may be old hat. You've seen this numerous times and are very familiar. I'm going to talk a little bit about IPOs and talk about some of my personal experience with IPOs, talk about the difference between a broker and a dealer and how they operate. We're also going to talk about globalization. We live in a world in which people are buying and selling stocks 24 hours a day because of the different markets on which we can operate. And so we're going to talk about the importance of globalization and also some of the challenges that face us as we invest in a globalized society. Then we'll be talking at the end here a little bit about being able to leverage our dollars. So we can do this by purchasing on what's called margin or selling stocks short. That means betting that stocks are going to go down in value. So we'll be talking about margin transactions and short sales here at the very end. So first, let's set up a little bit of terminology. This comes right out of your book, but I think it does a good job of setting us up in preparation for what we want to talk about for the remainder of the chapter. First off, we have two different types of markets. We have a short-term market and a long-term market. The focus of this lecture is going to be on the longer-term market. However, short-term markets are very important as well. So these short-term markets are called money markets. This is the market where short-term securities are bought and sold. You maybe have an investment account and you notice that the assets are swept at the end of the day and they're invested in what's called a money market mutual fund oftentimes. That means that the securities are swept and placed in investment overnight if you're not using those dollars to purchase stocks or bonds or something along those lines. So money market securities tend to have very low levels of returns. These can range anywhere from as low as less than 1%, so maybe in the 0.5% range, all the way up to as high as 5% maybe for short-term securities. You might see them a little bit higher than that now and again, but it's very rare. I would say money market securities on average run between 1% and 3%. So money markets, again, these are markets in which you would buy and sell securities that have short-term durations. The focus of most of what we'll be talking about, because it makes up the bulk of most people's portfolios, will be capital markets. So these are markets where we buy and sell long-term securities. The stock market, for example, is a capital market. The next two pieces are primary and secondary markets. You may have heard the term IPO when something goes public for the first time. A very popular IPO in the last several years has been Google. So several years back, Google went public, and in the process, they sold those securities for the first time on the primary market. Once those securities were sold on the primary market, they moved into the secondary market. So primary market is where new issued securities are sold for the first time to the general public. Does that mean that Google had no owners prior to that? No. It means that Google, before it became issued as a public security, was owned by private individuals. So you had investment bankers and individuals that owned that company prior to going public. Once it went public, though, the secondary market would be a market such as the New York Stock Exchange or the NASDAQ. This is a place in which a demander and a seller of a security can meet together and buy or trade securities at a given cost. So let's step back for a moment and talk about these primary markets. The first one, the first segment that we want to talk about is an IPO. So whenever a company goes public, the first thing that they want to do is determine if it makes sense for them. I was working for a company several years back. It was in the 90s. I worked for a bank, and during my time at that bank, they went public. So they took the company and went public. I'll be sharing little pieces about that experience throughout the semester, but I think it was really interesting because you see a lot of dynamic shifts for a company if you're working for them, and you've seen the pre-public and the post-public offerings. You'll see a company changes quite a bit, and they start to trim away a lot more fat and become a lot more efficient most of the time whenever a company is first issued public, because there's a demand by shareholders for squeezing out profits over the longer term. So whenever a company decides that they want to go public, the reason for doing so is a need for capital. So let's say you work in a little regional bank and you want to grow your branches out across the state and offer more services, open up more branches, open yourself up to additional consumers. How do you do that? Well, I can either go borrow the money from a bank, I can go and issue bonds, or I can go and issue stocks. Now, there's some other ways to raise capital, I realize that, but these are the primary forms of going out and raising funds. For many companies, what they ultimately do is they go out and they issue stock on the public market. This is called an IPO. This isn't as easy as just going out and saying, oh, let's issue stock. It used to be years ago before the great market crash, but with the crash of the 1930s, when we saw a lot of companies that were issuing fake shares for fake companies, we created the government got together and created the Securities Exchange Commission. And so what this group does is goes in and regulates the sale of securities. So the SEC requires that there is an approval process whenever a company decides to go public. So the primary market, or the three choices in going in the primary market, would be a public offering, a rights offering, or a private placement. And we'll be talking about those later on in this lecture. So what's the process of an IPO? Let's just kind of walk through this. Your book does a good job, I think, of outlining this. First, in the IPO process, there is an underwriting. So in the underwriting, you get a group or a syndicate together, which would be an investment banker and a group of investment bankers that gets together and promotes the stock in facilitating the selling of the shares. So underwriters get together and they value your company is essentially what happens. They come, they do site visits, they look through balance sheets, income statements, and they determine how much is your company worth, how much money would you like to raise, and how many shares does that equal to at a given share price. So they're going to do that, and they're going to make a determination of whether or not they want to handle the risk themselves. So let's say that Goldman Sachs comes out, or as a matter of fact, I'll run a different example. The company that I worked for was in Arkansas, and so there was an underwriter there called Stevens Incorporated. So Stevens came, met with the bank executives, and made a determination on the price of the bank. So the per share price and the amount of shares that needed to be issued. In that process, Stevens decided that they would handle the underwriting by themselves of this particular issue. Why? Because it wasn't a really large issue. We weren't talking about hundreds and hundreds of millions of dollars. We were talking about less than $100 million in capital needed to be raised. So what Stevens did is said, bank, what we'll do for you is we will take these shares and we'll purchase them all ourselves. So Stevens, let's say, purchased $50 million worth of shares from this little regional bank. Why did they do that? Because they have a brokerage network through which they knew they could go out and sell these shares. So they said, we'll purchase them at a discount. So if you want to raise capital of, let's say, $50 million, then what we'll do for you is at a discount, we will purchase all of those shares from you, and in the process, we'll make money ultimately. The way that they're going to make their money is the discount through which they purchase the shares versus what they sell the shares for is going to be substantial. So it's upwards of 5%, let's say, of the issuing they get to pocket, and that's what they get to skim for their profits in underwriting this process and the amount of risk that they're taking on. It's very risky. You can see if you look through at IPOs starting in the 1980s through today, the number of IPOs will fall during periods of economic decline and increase as the economy picks up. Why? Because there's a lot of risk associated with doing that. So the underwriter also facilitates in the process of registration. So you have to create what's called a prospectus. So this is a statement, a registration statement that describes the issue and the issuer. So in this instance, it describes the stock that was being issued and the bank that was issuing the stock. Next, you have a piece of that which is called the red herring. They call it the red herring because of the writing that would be on the front. So you can see in a piece of a prospectus, a red herring is this preliminary, normally it's just one sheet, and it talks about the company that's issuing, the class of shares that they're issuing, the number of shares they're going to issue, the size of the issuance. So it's just kind of a one-pager of who's issuing shares and what's available. Your book gives an example of Yelp. So you've maybe heard of Yelp before. Here is some shares of Yelp, and you can see an example of what that red herring would look like. Then you have sort of this quiet period. This is after the prospectus is filed. The company is really restricted about what they can say. Why? Because you don't want to see a company go in and start to mess with the stock price by making all sorts of different statements, pumping up the price and getting people excited. After that, though, after the quiet period is over, then the underwriters will go on a roadshow. So they go around and they use the preliminary prospectus and some other documents and start getting buyers excited about purchasing this security. So who's involved in this? We have an underwriter. If it's a large issuing, an underwriting syndicate, that is a bunch of underwriters get together and say, you know what, let's all get together and determine whether or not we want to purchase this security together, because it's too much risk, let's say, for one company to undertake. If you're wanting to sell, let's say $100 million worth of shares, that's just too much risk for one underwriter or one company to go out and purchase. It's too large. So they get together in syndicate form. You'll see insurance companies do this as well. If you've got a really large building that's worth, let's say, $100 million or more, one insurance company doesn't want to insure the risk associated with that company. World Trade Center is an example of that. The World Trade Center didn't have a single underwriter. It didn't have a single insurance company insuring it because the risk associated with catastrophic loss was too high. It could fold an entire insurance company under if it was lost. So you see a number of companies come together and syndicate to underwrite the risk associated with that because it's too large. Then you have what's called the selling group. Oftentimes the underwriter can also be the selling group, or it could be two separate entities. Let's say Goldman Sachs, for example. Goldman Sachs could be an underwriter which helps you. So they're an investment banker underwriter. So if you're wanting to go public, they will meet together with you, help you through the SEC shelf registration. At the same time, they'll underwrite the risk. They'll purchase all of those securities from you. So the $50 million that you want to raise, they'll give you a check. They'll take all those securities, they'll go out and they'll be a seller of those securities as well because they're a broker. They have people working for them who are brokers that are selling securities out there in to their clients. And so you have a selling group that could be the underwriter, or it could be other groups as well. So sometimes you'll see a Goldman Sachs, let's say, team up with a Morgan Stanley or a Bank of America or another group, and that other group has a brokerage force that will also help sell this particular security. A tombstone is just simply the announcement. So it's the announcement of the issuance and the participants involved in the underwriting process. Lastly, talk a little bit about compensation. These people make a lot of money. Investment bankers, underwriters, brokers, all of them play an integral role in facilitating market transactions, but they make a lot of money in the process. It's a relationship business for many of them. How do you find a company to help them go public? Well, normally they find you because you're in the business of doing just that. How do you find clients to be able to sell your IPO securities to? How do you get involved in this process? It's a sales, that part of the business is very sales oriented. You have to develop a clientele in which you can facilitate these transactions with. But if you're driving around downtown Dallas and you see somebody driving a Maserati, normally they're involved in this kind of business. These are people that make a lot of money for what they do. It's a lot of work, but there is a lot of money involved in the process. So the investment banker normally, and I said this already, the way that they receive compensation is in the form of a discount on the sell price associated with these securities. So that's what they receive. You can see that visually here. So you have an issuing firm, let's say First Federal Bank. You have an underwriting syndicate in a large group, so Stephens Incorporated. You have a selling group. Well, that was also Stephens Incorporated. So Stephens had a brokerage firm as well, a brokerage group that was going out and selling these securities. So real quickly, I'll tell the story of how that operated. I was working at this little bank, and they decided they wanted to go public because they wanted to expand from a 3-city bank to a regional bank that would sell across the state of Arkansas. So this little bank decided they want to go public. They meet with Stephens Incorporated, who is one of the very few groups out of the state of Arkansas that worked as an underwriter. And they sent in auditors. So you would go in the boardroom and there are auditors in there all the time overlooking the books and helping determine pricing and value of this little bank. So the bank had assets, I think at that time, of probably somewhere close to 400 million, something like that. So it was about a $400 million from an asset perspective bank. And they decided to take it public. I cannot remember the size of the issue, how large it was. But what they settled on for a pricing point was $10 a share. So if you could get in on the IPO, you could purchase the IPO for $10 a share. Pretty good deal. When you started to look at the numbers, it looked like the security was probably valued slightly higher than $10 a share. And so I had several friends who were working for the bank at the time that leveraged everything to buy as many shares as they could. They would allow any one person within the bank that was you had to be an employee by the bank or you had to be a customer of the bank. Being either one of those two, you could purchase up to $250,000 worth of shares. So you could purchase for $10 a share, and I saw a lot of people do that, maxing out at $250,000 worth of shares. The day that the stock opened and it was sold on the NASDAQ exchange, so the day that it hit the secondary market, that security was selling for $13 a share. So you purchased it for $10, and a week later, you could sell it for $13 a share. That's a 30% increase in a very, very short period of time. A lot of people made a ton of money doing that. That security, that was in the 90s. That was like 1995, I think, somewhere around in there. Maybe it's 94. That would have been 95, 96. That security, I think it topped out at about $120 a share. So this shows you some of the volatility in the stock market as well. You had people who made a lot of money very, very quickly in that IPO, but had you held on to this particular security because they made some bad financial transactions, and we went through the financial crisis associated with banks, this particular bank had to take TARP money. They had to take bailout dollars because of some bad loans, and you saw the value of this company plummet from its peak to where now they're in the process of just trying to reorganize and get their feet underneath them.